welcome to the Loan Officer Training Series with the Mortgage Calculator. We will get started here in just a moment. We're doing a training today on 1099 loans. We will get to it in a minute, just waiting for us to get live on all the different platforms. We are streaming this live on YouTube, Facebook, and LinkedIn, and we'll give everybody a chance to tune in. We put the chat up on the screen so you can keep dropping comments. I see people were already commenting that were tuning in early. Appreciate that. We'll get started here in just a few moments. Shout out to the Mortgage Calculator team tuning in. All right. Looks like we are live on all the different platforms, so I think we can go ahead and get started. We can go ahead and take the chat off the screen there so we can get into it. All right. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We're a correspondent lender that specializes in non-QM loans. We do this loan officer training series every Tuesday and Wednesday night at 7 p.m. Eastern. And what we're going to be talking about tonight is a continuation of what we've been talking about, which is 1099 loans. So tonight we're going to talk about some scenarios and going through some actual rates and stuff of some 1099 borrower loans. Now, we'd be happy to answer any questions that anyone has. So feel free to drop any questions you have there in the chat, and Jose can answer them. So Jose Gonzalez, our sales manager with 27 years of experience as a loan officer and a realtor, very familiar with 1099s, especially because realtors get 1099s, right? So we'll let Jose talk about, what a 1099 loan is, and then go into some examples. So go ahead, Jose.
All right. Good afternoon or good evening, everybody. Thank you for joining us for our training tonight. So first, let me give a little context to the situation by talking about our different income types, right? We have full doc, right, where we're using tax returns, and depending on the type of borrower, maybe just pay stubs and W-2s. If they're self-employed, we're going with tax returns. If they have an investment property, we're going to need tax returns as well for the Schedule E income, right? So we could have a full doc borrower, and then we could have our alternative documentation type borrower. Now, full doc can be agency, which could be conventional, FHA, VA, or USDA. But now when we go into the alternative doc realm, that is strictly only non-QM. And at the Mortgage Calculator, we definitely love non-QM because it provides so many options. That's why we have over 5,000 different loan products to be able to offer to you. So now in our non-QM realm, again, we have our full doc, we have our alternative doc, which could be 12 or 24 months business or personal bank statements. It could be asset depletion, where you're using liquid assets divided by a certain number of months, depending on the formula for the particular guidelines that you're using for where we're submitting the loan. It could be asset utilization, which is just another name that they give to asset depletion, again, using liquid assets. And then you work it through a certain formula to come with a monthly income. It could be 1099, which is the one that we're using tonight, which is going to be an IRS 1099 form that is given to the individual, and is considered non-employee compensation. As we went over last night, borrowers that receive the 1099 NEC, which is the specific 1099 form for this product, are usually going to be, or always going to be, either a sole proprietor or an independent contractor of some type. They may have been a W 2 employee for that company, but then the company could have transitioned to only treating all of their workers as contract workers, or as, independent contractors, or they give them a set contract to get paid, and then it is the responsibility of the borrower to file their own tax returns. And that is where the magic starts happening for these 1099 loans, because you ask yourself, why would I use a 1099 guideline type loan to qualify my borrower? What are the benefits of that? Well, there are many benefits, because, as you know, most borrowers, when it comes time to do their tax returns, are going to look at each and every deduction that they can possibly take to reduce their taxable income, and hence reduce their tax liability, right? That's everybody's desire, is to pay less taxes whenever legally possible. And that is why we would use this program, because we don't have to provide tax returns and be showing all of the deductions that the borrower is taking. The only thing that would have to be done, it would be to provide a transcript, a W 2 transcript, which would show the instrument filed. It would only show the net, the gross amount of the 1099. And this is just to confirm that your 1099, or your borrower's 1099 that says $88,000, was actually filed to the IRS by the company that is contracting them, that they actually filed the 1099 for the same amount, just to confirm that there is not any fraud. And then the beauty of the program is that it allows up to 90% of the income on that 1099 to be used as the income for the borrower. So that is the reason why you would ever structure a loan using the 1099 guidelines for your borrower, right? So instead of having the borrower maybe that's claiming $100,000 and having a net income of $30,000 or $40,000, he could possibly, or she could possibly, have a net income of $90,000 if we're using the best case scenario formula for the 1099 loans. Now, again, I repeat, it is for self-employed borrowers only, right? That does not mean that if you are a 1099 borrower, like I mentioned last night, that you cannot also be an employee of some other company where you're also getting W 2 income. That's not an issue. And in some cases, we can even combine those separate income streams. So we could have the borrower qualifying with 1099 income, as well as W 2 income, as well as, if they have another business that they have bank statements for, bank statement income. Just can't duplicate the bank statements from the same business that you're using for your 1099. That would be double dipping, and not something that we would be allowed in any situation. So, like I was mentioning, realtors are probably one of the best sources for these 1099 loans. A lot of times we think of realtors and we only think of bank statement loans. But the bank statement loans have the disadvantage that the default expense ratio for the bank statement loan is 50% versus 10% for the 1099 loan, because you're getting 90% of the income versus 50% of the income in the default for the bank statement loan. Now, there are cases where, depending on the guidelines, the employer will have to provide verification that the borrower does not have business related expenses, right? Because if they do have business related expenses, then that's obviously going to come off of that 90% and is going to reduce the net income amount. You're not going to be able to benefit from that 90% figure. Uh, and also, obviously, this program does have certain FICO score requirements, right? For the 90%, 700 is the minimum FICO, like I'm going to be showing you in some examples in a little bit, with 600 being the minimum FICO score for an 80% loan to value. So again, you can see the benefits of going 1099 over bank statements. Definitely 1099 is going to be preferred over the profit and loss uh, option, because in the profit and loss option, not only do you have to provide the profit and loss from the tax preparer, which is an additional step and additional document, which may not always be possible, because if your borrower self prepares their tax returns and does not have a tax preparer or a CPA or an accountant that can write the third party verification letter attesting that they prepare the tax returns for that borrower and at the same time are the ones that are preparing the P&L, then the profit and loss option would be very difficult, as most of the P&L options require that you have a third party verification. So again, the 1099 does not require that. What it does require, like I mentioned a couple minutes ago, is the wage transcript from the IRS, which is going to hopefully match the amount of the 1099, because the employer does report that 1099 exactly, and there are not any tax deductions taken from the 1099. It is a gross income where the borrower does have to cover all of their own taxes at some point. So again, you see the benefits of the 1099 program over the bank statement program, in that you have the higher profit margin or lower expense ratio, whichever way you want to look at the analysis. Whereas on the bank statement, it's 50% the default. In the 1099, it's 10% the default. And in the P&L, you have to get the accountant to provide the letter. And then asset depletion is really has no bearing in terms of your if you're self-employed or if you are not self-employed. It is simply based on liquid assets, right? If you have $500,000 in the bank or $1 million, you divide that by a certain number of months, depending which option for that program you're using, and that's your monthly income. But again, no bearing on the type of employment uh, when comparing it to a 1099, which is for self-employed borrowers only. So let me share some examples here with you on some type of different loan scenarios that you can use for your 1099 borrower. Again, remembering that this is a self employed only borrower. And in many cases, one thing I didn't mention, but I did briefly mention it last night, in many cases, the borrower can only derive the income stream from one source. What do I mean by that? Is there has to be a company that is contracting that borrower for the work, right? It can't be like he's a freelancer and just getting it from all over the place. The majority of the options do require it to be from one source. So as soon as the video queues up here, I can get into the scenario here, which is going to be for a real estate agent with a 760 credit score, right? Our real estate agent is paying all of his bills on time. 760 credit score. 90% LTV is the maximum for this program, like every other non QM program. 90% is the maximum for a primary residence. All right. So here we're looking at a 760 score, like I was saying, and 700 is the minimum credit score for a 90% LTV. I'll show you that right in a minute. But here you can see where you're looking at rate range anywhere from 9.625 to 8.875. And again, like I mentioned, no mortgage insurance is ever applicable on these non QM loans. So our real estate agent, we're assuming that they've been working for the same real estate company or contractor, or I guess for realtors, they'd be hanging their license at the same company uh, for the minimum amount of time that our particular option may require it, and they can go 90% LTV. Now, in our other example here, we have an electrician, right? Licensed electrician. He has a 700 credit score, but he can still do 90% LTV. Now, why am I using a licensed electrician here in this example? Because I want to convey the message that this program will allow the borrower that's been in business for less than 2 years, as long as they've been in business or as a 1099 contract worker, let's say, for at least 12 months. But previous to that, the borrower was a licensed electrician for a company as a W-2 worker. So if you do have that transition from licensed electrician W-2 worker to licensed electrician sole proprietor getting a 1099, as long as you have at least 12 months worth of employment, and you have to have a 1099 for the previous year. That's really what it's going to boil down to. It's not just 12 months, right? You have to already have that 1099 from the previous year, and hopefully it's going to be enough to get you where you need to be. But the key here is that in order to be able to even qualify for this option, they have to have been licensed in the trade or in the profession. So I use electrician as the example, but it could be, for example, a nurse practitioner that needs to have a license. They were previously working for a company, and now, let's say, maybe they're working for an agency as an independent contractor, nurse practitioner, and they have at least 1 year's worth of 1099s. And they've been doing it for a year, and they were doing it before for at least a year, but preferably longer. That would be an option that would be possible under this program as well. So, in our example here, with the 700 credit score, you can see that the rate does increase a bit, but then again, it's still 90% loan to value. So now here, using again a carpenter, which would be a tradesman, we can assume that you do have licenses for carpenters, depending on if they're like a journeyman. I guess it would be like union stuff like that. So in this scenario, we're considering 85% LTV. We're going here with a 700 credit score, which is the lowest credit score that is allowable for an 85%. So 700 is the lowest credit score for a 90%. You saw, like 1% higher rate, and 700 is also the minimum credit score for an 85%. But you see here that the rate drops. If I go back a minute to the other one, it was 10.875. So here our minimum cost rate does drop by 1%, and the cost also drops by about $4,000. So much more affordable and much better rate, just dropping the loan to value by 5%. So if we look at this scenario here in our loan amount, uh, it's about what, about 1% in cost less. We have our $425,000 loan amount. Over here, we were looking at 5,063. So now we're at 1,063. So it's almost 1% to get this much better rate. When if we were to go here, the other one at 9.875 costs a little bit over 2 points. So and that's at 90%, right? Look at that. So 9.875 costs you 2. So it's about a 3 point benefit. In this scenario, you do have a benefit going if your customer is 700 credit score. You do have a benefit going if you're just looking at the rate and looking at the cost. But if you want to get lower in the rate for the same cost, then obviously 9.125 is much lower than 9.875, which was the lowest rate at the 90% LTV. So that's the consideration that we always have to make when we're analyzing the LTV and rate options that we offer the customers. You're looking at the cost benefit analysis. Is it really worth it to go to stay at the higher LTV? Is it worth it to go down maybe 5% in LTV but get much better pricing? So here there's a little bit of a difference in pricing, but it's not so much so that if you're really looking at where we are, again, the 1% higher rate to, yeah, I mean, here you're not, you do have a much lower cost here at the 9.875, but it's not so different when you're looking at 10.875 costing 5,000 and 9.875 costing 95.63. Not as different as I see it in some of the other scenarios. So the 90% does look to be a good value there, unless your customer absolutely wants a rate lower than 9.875, in which case you definitely would have to go to the 85% at the 700 credit score, which is probably the only reason why you'd go this option, would be if the customer just definitely wanted to have a lower rate and wasn't so keen on the cost. So now we're talking about our welder, right? And we are lowering our credit score here to 660. Hold on one second. So we're lowering our credit score here to 660. So you see at an 80% LTV at a 660, we still get pretty good rates, but that's not the lowest score that we can go. We can still go a little bit lower than this. But again, I'll show you the differences here. But 660, you can't go any higher in LTV than 80%. So now I'll show you a 620, right? And here you still get 80% LTV. 600 is the minimum credit score for an 80% LTV loan. Will probably require you to put a little bit more into reserves because it brings your credit grade down. I believe this would probably put you at a C credit grade if you wanted to maintain the 80% LTV, and it's probably going to require 6 months of reserves instead of 3 months. But if we look at the difference in the rate and cost over here, 10.375 is par, whereas over here you don't even have a 10.375 option. So if I look at you don't really have any options in that are in this 620 credit score grid that you could meet and compare. This is just simply for the person that has no other choice. This is what they got to do. and you're looking at 11.499 as your lowest cost option, and you can buy that down to 10.625. So again, I mentioned 600 credit score is the minimum score. So to illustrate that for you, yes, it is possible, and we do have borrowers out there that could definitely benefit from this as long as they have at least a 600 credit score and 20% down. Obviously not the best scenario. At 11.499 at that cost on a $400,000 loan, that's about two and an eighth, almost a little bit over 2.1 points as your lowest cost option. And then the only other rate option that we have that's in compliance is 11.375. Now, you may be able to buy it down a little bit lower than that, depending on your loan amount. You can do the points and fees test. And as long as you are under 5%, you would be good. I know there were a couple other options that were a little bit higher in cost than this one. This one at $9,500 is what, about 2.375, something like that in cost. So we can go a little bit higher on a $400,000 loan than that. Maybe I don't think you're going to break lower than 11%. But then again, this is a good scenario for a borrower that needs to get into the home. Then you can consult them, do a credit simulation, help them work on their credit to get it back up to where they need it to go. In this particular case, in these scenarios I've done are primary residences. I haven't done any investment property options here. And you know that on the primary loan, there's never a prepayment penalty. So maybe a year down the road, year and a half down the road, they've improved their credit, and you can refinance them out of this loan. Maybe they can go bank statement, or they're going to go 1099 again, but with a 760 credit, and you could get them a rate, 2-3% lower, and help them substantially save. Because in this scenario here, our payment is 3961 at an 80% LTV. But in a first example that we did, you're looking at a payment of 3825 at a 90, right? So that's a pretty good rate. And here, even at a higher rate, you're looking, 42, 43 at a 90. So again, it's going to be a little bit higher rate, higher payment. But in this case, if it's an 80%, and you get them to the lower rate, you're going to save them a few $100, like 3, 4, 5, 600. Even in this scenario here, going down to 10.696 at an 80, you're saving them like 300, almost $300 there, and you would probably be able to get them into the eights on an 80%, probably the low eights if you get their score above a 700. And then you're going to be saving them probably $600 to $700 a month. So a lot of options there. If you do have your 600 credit score borrower, don't fret. Help them out, and then help them build up their credit.
All right. The only question I see here was basically what you just went through, right? So Richard asked that before you went through the whole comparing the scenarios. But yeah, absolutely. That's basically what we went over today, was how to determine whether to use 12 months bank statements versus 1099 versus profit and loss.
Yeah, let me just rehash it again. Richard is basically going to deal with the fact that the 1099 has a default expense ratio of 10% versus the bank statement loan having a default expense ratio of 50%. Now, with the bank statement loan, you are able to lower the expense ratio, but that would entail obtaining a letter from the tax preparer or accountant or CPA, depending whichever one that they use, that would have to provide a business narrative, and included with that business narrative at the end of the letter is going to have to be an additional sentence regarding the expense factor for that company. And the expense factor that they put has to make sense for the company. And on top of that, in a lot of the bank statement options, they already have predetermined expense factors for certain business types and certain industries, right? So, depending on that business type or industry, that letter may or may not help, right? So, you really got to look at the guidelines of wherever you're submitting the loan. Whoever guidelines we're using, let's say for the option, and make sure to see how much flexibility you have regarding using the third party verification letter to improve the expense ratio.
And also, too, when we're using bank statements, now we're opening up bank statements. We're looking at insufficient funds and overdrafts. We're looking at large deposits and sourcing them. We're looking at if the deposits are declining month to month, we have a problem, right? So, just opening up those bank statements can open up a whole lot that won't be opened up when we're doing a 1099, right?
Correct. I mean, with the 1099, they will ask in most cases for the last 2 months bank statements just to confirm the income stream, since they're not really going to ask for pay stubs. They don't really care about pay stubs. They're looking more at what they're if they're actually depositing the money in the bank, right? So if the borrower has overdrafts the last 2 months or stuff like that, please be on the lookout and make sure that you review the guidelines of whichever option, 1099 option you're considering, to ensure that that's not going to kill your deal.
All right. Well, I don't see any other questions, so we can go ahead and wrap it up. Thank you, everybody, for tuning in. Remember, we do this every Tuesday, Wednesday night at 7 p.m. Eastern Time. So we appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all next week, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a good night, everyone.
Thank you.